Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Let's talk about the first week of July. Usually we get some really good US economic indicators that tell us how the labor market is doing, how the economic situation is doing in the United States. So we're going to go over a few of these data points here, and we're going to end off mostly focusing on the job market in the US and what it means in terms of the outlook and how people are feeling with the current strains that we're seeing with the interest rates and this inflation and all of that, right? We tend to look at these data points at Infovest on a monthly basis as they come out. We tend to monitor them to see how the situation is panning out from a month-to-month basis in terms of the economics, in terms of the health, the outlook, the growth. And it gives us kind of an idea, especially where interest rates and inflation is going to head towards. So let's first talk about Monday, right? Monday, when I scroll through here, we had the ISM report came out, ISM manufacturing report came out basically worse than expected at 46.0. The expected number was 47.2, and the prices component came in lower than expected as well. And the employment component, which is also very important, because remember the US Federal Reserve told us that they're looking at the labor market. The labor component continues to be quite strong, which is keeping those wages up and keeping inflation. Inflation has come down from its highs, but keeping it still far away from their 2% objective, their 2% goal. So when you look at the ISM manufacturing report, the report basically tells you how the manufacturing industry is doing in the United States, and it came in weaker than expected, which is basically telling you that, hey, the manufacturing sector is doing poorly. And generally when a number is below 50, tells you, hints towards recession, right? So this number tends to be a leading indicator when it comes to figuring out contractions or expansions within the economy. So this number came in at 46.0. The prices component, which is also a good gauge of inflation and whatnot, that came in lower than expected. Expected was 44. The number came in at 41.8. And the employment component also came in weaker, right? The expected was 50.8. The number came in worse than expected at 48.1. So when you look at this, right, when you look at these numbers, you could say, okay, the economy is starting to feel the weakness, the blows. So that means that, hey, there's no need to hike rates as aggressively, right? Well, let's take a look at the other data points, because this is not the only one that we focus on and that we care about. Now, we also had the US Federal Reserve come out with its minutes. Tuesday was a holiday in the US, 4th of July. So the minutes came out on Wednesday, July 5th. And basically the minutes were just reiterating what the Fed said last time, right? The Fed just said, hey, we're going to expect to see more rate hikes. We expect to do that. So we're not done. We will continue to monitor the data. Inflation still needs to come down, and we're basically not backing off. And, the markets kind of just shrugged it off as it did in the last FOMC meeting. And now you're getting the markets pricing in a 90% probability that, yeah, hey, we are going to get a rate hike. The US is going to get a rate hike this month. Now, moving on Thursday, which is very interesting here, the ADP non-farm employment change, right? That number, it's a private number, comes out from the ADP institution. That number came in higher than expected, came in at 497,000 versus the expected of 228,000, right? That number, if you break it down, and you look at what caused such a amazing beat, you could see the servicing providing section came in hotter than expected, added more jobs when you look at the trade, transportation, utilities at 90,000. The leisure and hospitality, education, health services also came out higher. So 232,000 for leisure hospitality, 74,000 for education, health services. Now, the information, financial activities, professional and business services came in lower, came in at negative. So starting with information, negative 30,000, financial activities, minus 16,000, and the professional business services, minus 5,000, as you see in red. The other components also, when you look at the small establishments and the medium establishments, so small establishments added about 299,000, and the medium establishment basically at 183,000. If you break it down, the 1 to 19 employees was about 162K, the 20 to 49 employees about 137K, and the medium establishment 50 to 249 employees 171,000 versus the 250 to 500 or less than 500 employees about 12,000. But if you look at the large establishments, 500 plus employees, the large establishments noticed that, hey, we saw a decrease in the employment. So actually minus 8,000. And that's what you've been seeing, right? That's what you've been seeing in some of the news in the past couple months or even a year back, where you heard a lot of these large establishments, especially the big tech companies, lay off workers. Because if you remember during the COVID pandemic, a lot of people, especially in tech, got hired. And because of that, you had an increase in the employment, and there you go, massive increase in employment. And they got stimulus money and everything was doing well until all of a sudden, we see contraction, higher rates, and now they're laying off workers. So not a surprise there, but very interesting to see that the small and medium businesses have increased. Now, this number is private, right? It comes out from the ADP. Some people like the number. Some people say that these numbers that come out from the ADP is always misleading and always different, and they don't like it because there's another number that comes out, and that's on Friday, which is the non-farm payrolls report. It comes out from the government, and it's a highly anticipated number that a lot of traders, economists, even the president looks at when it comes to figuring out how the job market is doing, right? So if we look at the non-farm payrolls on Friday, let me just scroll down here, we basically see the number, the headline number coming weaker, right? So completely opposite than what the private number was saying. Private number said massive increase in jobs, but the government number came out, said no, non-farm payrolls report saying 209,000 versus the expected of 225,000. So actually a decrease in jobs for the previous month. Now, when you look at the other components like the unemployment rate, it's steady at 3.6%, so no change there. When you look at also the participation rate, no change there, 62.6%. And most importantly, what you want to look at when it comes to the inflation, the wage growth, right? Again, why is this important? Because the Federal Reserve told us that, hey, wage is sticky up there. The core component of inflation is sticky. If wage continues to go up and the labor market continues to be strong, then, you're going to see inflation stay around for longer and way above our 2% target, our 2% goal. When you look at the inflation component, the average hourly earnings, the year-over-year number comes in at 4.4%, and the expected is 4.2%, so higher than expected. And it's especially also the revised number, right? The previous number before this number came in also higher at 4.4%, right? So the number there is telling you that, hey, wages gone up. Yeah, you saw a little bit decrease in the jobs, but wages have gone up, and that's creating that inflation narrative, which, may signal that the Fed may continue hiking rates further and further. Now, let me just quickly figure out and see, and I'm doing this right now live, is what the probability is now after seeing a weaker jobs number, the non-farm payrolls number, with the higher inflation. So I told you in the beginning of this video is around 90%. Well, when I look at the probabilities of a rate hike this month, right? So the meeting for the Federal Reserve is July 26th. The probability of a 25 basis point rate hike is sitting at 92%. So just like I was saying in the beginning, there's no change there, even though there was a slight decrease in the jobs. You might say, hey, look, Daniel, the government numbers are saying that, jobs got a little weaker. Shouldn't that stop the Fed from hiking rates? Well, according to the probabilities, no, right? Like I said, the wage component's still up there, and they want to see inflation come down to the 2% target. So even if it's just slightly above its level, and even though inflation has come down massively from its peak, it's not stopping the Fed from continuing to hike rates. And you can see that from looking at the probabilities, which sit again at 92%. Now let's break down the non-farm payrolls report. The focus tends to be around the establishment data. That's what the news and the media and everybody looks at. Establishment report tends to double count jobs, tends to be misleading at times. And when you look at the revised numbers also, you've seen that payrolls for every month this year have been revised lower, right? So we get this report, we're going to get, the revisions again, and we're going to see the revisions and see that, okay, this report, is it true or is it worse than what is expected or better than what is expected, right? So this is the number we see right now, but we're going to get the revisions next month and see, okay, what's the real number looking at, right? So with that in mind, the establishment data can be a little bit, in my opinion, misleading. But let's talk about it, and then I'm going to talk about the other number, and the other report, which is the household, which is the report I tend to look at, which doesn't really double count the jobs, right? So what does that mean by double counting the jobs? That means that if you're an individual and you're working and you have 2 jobs, I'm going to count 2 in my report. But in the household, you're one person. If you got 2 or 4 jobs, doesn't matter. It just means that you're employed. Whether you have 2 or 4 jobs, we're going to count you as one. So you could have one person who has 3 or 4 jobs, and it will look like 4 people are working, which will be included in the establishment. But the household doesn't look at that. Household's like, okay, you got 4 jobs, doesn't matter. You're employed. Whether you've got 1 or 4 jobs, we're going to count you as one. So that's why sometimes the establishment data can be a little bit misleading because of that, because it's double counting jobs, and the household not so much. So let's first look at the establishment, then we'll look at the household. So the establishment number, like I said, came in at 209,000. When we glance at the report real quick here, the total private numbers, 149,000. We saw that the goods producing came in at 29. So higher, more additions there. The construction came in at 23. And if you look at the other components, private servicing provider came basically totaling at 120,000, but you see the weakness, the negative numbers, which mean the losses that you're seeing at wholesale trade at 3.6. Transportation warehouse 11.2. You're looking at retail trade 11.2, transportation warehouse at 6.9, and if you go further down, you see that temporary help services minus 12.6, and then healthcare social assistance 65 plus, government 60 plus, other services 17, leisure and hospitality, like I said in the ADP report, came in higher, and it showed here in the government report also at 21. So it's looking like certain areas doing good, other areas not so much. You're starting to see more negative numbers in the report, right? And we're just starting to see this now, right? We're before the other numbers, the other reports were showing strong labor market, but we could start to see a trend where these negative numbers start to show up more, which is going to show you the signs that, hey, this recession that everybody's talking about, this deterioration in the economic growth is starting to play out. The data takes time, right? Recessions don't happen. It's not like the stock market where it happens right away, a big move happens right away. The economic cycle happens very slowly, takes its time, and you're starting to see that in the establishment report, right? You're starting to see those negative numbers creep in. Now, what's going to be very interesting is the future establishment data reports, the future non-farm payroll reports, when they come out. It's going to be very interesting when that number starts to deteriorate further and further and further, and you start to see more of these job losses. You're going to see it in the establishment, and you might even see a negative payrolls number. Yes, a negative payrolls number, which is going to show, okay, yes, the real signs that the economy is hurting. Now, let's go into the household data here. The household data came in higher, little bit higher. And if you look at the June's number, 266,801 versus May, 266,618. So slightly higher there. However, if you look at the numbers since June of 2022, the household number is fluctuating. It's staying in between 263,000 to 266, so around the 260K area. And it's just fluctuating up and down, kind of like consolidating, right? When a stock chart consolidates and trades sideways, same thing. This data is doing the same thing where it's kind of moving in a sideways pattern. And generally when this happens, you tend to see the data turn down and the numbers turn down. You start to see the numbers really get worse off. And it always happens when the numbers are flat, right? So you had the numbers going up and doing well during COVID, after COVID, 2021, and so on. But then 2022, with the rate hikes and the contraction in the economy, you see the numbers have been stagnant. So if you can kind of visualize the markets, the data points getting higher, staying stagnant, and then finally collapsing. And that collapse will happen again when it comes to the recession, when it comes to the contraction in the economy. Now, when I scroll down in this household data report, which is really important, I want to figure out what is the part-time workers looking like, especially for economic reasons, right? So when you scroll down this report, it says part-time for economic reasons. The number is sitting at 4,191. So higher than May's number, right? May's number is around 3,739. So the number came in higher. And when you compare this number from a year ago, basically you see more part-time workers than 1 year ago, and basically adding at 452 more compared to a year ago. So what does that mean in terms of, if I just do quick math here, 452. So the number of June of last year was 3,631. The number now is 4,191. So if I just do quick math there to see what the increase is, and if I take 452 divide by 3,631, that number comes out to be 12%. So you had a 12% increase in part-time workers. So when you see that part-time workers increasing, and especially with the full-time decreasing, it's telling you that, hey, people are feeling the pinch, they're losing their jobs, their full-time jobs that they had or they currently have a full-time job and they're unable to handle the inflation and the price increases, so they're taking on maybe multiple jobs, right? Now, that's a very good question that you might be thinking, is that what does the multiple job holders data look like? Now, if we look at the multiple job data holders and see what the report looks like for the household data, we see that total multiple job holders also increased by 400. So, and this is over a year. So 7,432 to 7,880. So about a 5% increase in more people getting multiple jobs, right? So right there, this data is telling you that more and more people are flocking to part-time jobs because either they're having a tough time, either they're need multiple jobs because the cost is getting worse off. As you can hear and see with the rates going up, the mortgage costs going up, it's definitely eating into a lot of the disposable income for consumers. Now let's look at the full-time numbers, right? The full-time numbers, if you look at it, for June and May. Now the full-time numbers, the unemployed persons, according to this chart here, table A10, basically shows from June of last year and June of this year, so about a year, the full-time numbers has decreased. The unemployed persons have decreased, which is kind of odd, right? 4,900 to 4,875, but not much of a big drop there. Now, when you compare to May last month, same thing, 4,953 falling down to 4,875. Now, part-time, on the other hand, also has decreased, so you have more less unemployed people, so people coming back into the labor market because, hey, this was also another problem that, hey, we need more people in the labor market. Now, when you look at the unemployment rates for full-time versus part-time, part-time is sitting around 4% and the full-time is sitting around 3.5. And when you compare this also a year back, you see that the full-time component has decreased by a little bit, not so much, and the part-time is basically increased by a little bit. And that little bit we're talking about is about 0.1. So what's happening here, right? I thought full-time workers are decreasing. We're seeing in some components, but then when you look at this household data and you look at the numbers coming out here, it shows that, hey, the full-time workers are actually, the unemployment rate is actually getting better. So does that mean more people are moving into full-time jobs? Or could it be that, this data is misleading, or is there something else here? Well, if you look at the graph as a whole, right, the number's been fluctuating between 3.4 to 3.6. So if you notice there that, yes, you're going to get fluctuations, but again, that's stagnant. The fact that the numbers are sideways are telling you that, hey, you're not, even though might be a slight increase or decrease, even though there's slightly more people being employed in terms of full-time, doesn't necessarily mean that, hey, this is completely a good sign. Because if you look at the data over a year, it's been sideways, which is telling you that the big companies out there are uncertain about what they want to do when it comes to the rates. What they want to do when it comes to the jobs, right? So the jobs they're not hiring or firing. Now, some have fired and some have laid off, but they're not going to extreme levels just yet. And that's how companies usually react, because there is a cost to hire people, because it's also very hard to find skilled labor in this market right now, because this COVID thing has disrupted the labor market. They're not going to lay off workers just because they're predicting some sort of slowdown down the road. They're going to make that action in those decisions once it comes and once it happens, right? So they're, again, late. They do come in late to the game, not because, you know, they're bad at predicting or whatever. They don't want to run the risk that if this ends up being a Goldilocks economy and things, you know, you don't get that recession or that hard landing, then they don't want to make the mistake that they laid off people and then now they got to hire back and it's going to cost them more. So they're going to wait. They're going to wait. They're going to assess to see the situation. Is there truly going to be a hard landing, a hard recession? And then the decisions will be made during that time. So, you know, we're getting close to it, but we still may be far from that point. Now, when you look at the part-time component, the unemployment rate is around the 4% level. And when you look at the Fed's projections in its last FOMC meeting, it projects that unemployment rate is going to be at 4.1% this year, and then I believe next year around 4.5%. And that basically tells you that when the unemployment rate gets to 4.1, in history, we've always seen that a massive recession leads afterwards. And you've always seen that the unemployment rate spikes further higher afterwards. And that means more job losses afterwards. So even though that the Federal Reserve and central banks out there are telling you that, hey, don't worry, no recession, everything's fine, blah, blah, blah. But look at the projections. The projections are telling a different story. They're saying 4.1% by the end of this year, and then 4.5 next year. So they're definitely telling you that, yeah, we do see a recession at least for the next year. And that 4.1, especially going to 4.5, that doesn't mean soft landing. It's always some sort of hard landing, hard recession there. So very interesting to see that the Fed tell you one thing, yet they're projecting another thing there. And when you look at the part-time numbers, like I showed here, around 4%, it's not so far from the 4.1 that we've been talking about. Now, the 4.1, mind you, is looking at the whole the whole unemployment rate, considering the full and part-time. But it's very interesting here to see that the part-time is already feeling the pinch and is already higher than the full-time. And that can be understandable with the current situation we're in. And when these things start to topple and get worse off, you'll see those numbers start to spike up higher, according to the Fed and according to past history in the data. So let me know what you guys think. Leave a comment below. What do you think about this job market? Do you think that it's going to get better? Is it going to be worse off? Do you see a hard landing, soft landing, Goldilocks economy, etc., etc.? Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.